Hello, welcome to It's Your Smarter Money with Dr. Laura and Professor Steve, hosted by Atlas Fiduciary Financial. And today we're going to talk to you about the the second quarter of 2022. Just want to give you a status of where we are because recession fears, of course, continue to hit stocks. And we wanted to actually have a conversation about that. So we have a couple slides that we'd like to walk you through. And this first slide just gives you a picture of the traditional views of stocks and bonds. There is no conversation here about the enhanced asset classes, although we know that those asset classes actually have been a lot of them have done very well. But right now, we're just focusing on these traditional US stocks down more than international developed and emerging markets. And also bonds are down for the second quarter. And what we wanted to point out is that if you see, for example, bonds are down by 4.69% in the second quarter, it just so happens that the first quarter of 2022, it was down by 5.9%. So we are significantly down at this point, even in the fixed income sector, which tends to be the place that a lot of people hide.
I think this is the first time in my recollection that bonds have done so poorly, especially in the year in which the stocks have done so poorly. And in fact, the Wall Street Journal said maybe 2 months ago that this was the worst year for bonds since 1842. So we're sort of in some odd times here, times that we haven't experienced, at least in my lifetime, in some ways. But you look, the nature of every decline is always different. People say, gee, I've never seen anything like that before. That's just life. Things tend to be different in each decline or a poor year. So,
and the thing that I keep thinking about, Steve, when I look at this too, is that those folks that remain in those traditional 60-40 portfolios, large cap stocks and bonds, no wonder they're not too happy because they're really participating in all this downward pressure. Some people don't even have like the international or the other more value components and things, enhanced asset classes that we have. And they rightly so should be concerned.
and by the way, I wanted to mention, this is probably the worst year I've seen for international bonds since we started using that asset class, probably somewhere around 20 years ago. So this is actually quite unusual even for international bonds. And once again, I think it's really driven by the fact that a lot of central banks in various countries are increasing interest rates, in part because while we have very high inflation and among the highest in the world right now, sadly, a lot of other countries are experiencing high inflation as well.
Right. One of the things, as we are looking at the slide, that I also find interesting is below where we have the best quarter and the worst quarter. And you can see the wild swings, where the US stock market's average return is 2.2%. That means in one quarter, there have been instances where it was up as high as over 20% and down lower than 20% as well, which is just, this is the nature of the beast. It is a volatile, all of these risky assets are volatile.
And that's the kind of volatility that drives out people that can't really withstand it emotionally, because it is pretty shocking to see a portfolio drop 23% in 3 months. And we're all human. It's hard for us to really sort of stomach that. And Laura was mentioning that some of our portfolio, our assets in our enhanced models are holding up well. And I'll just name those 4 asset classes. Private equity, it's up around 3.8% for the year. The alternative lending is up around 3%. Reinsurance bonds are basically flat, and I'm leaving, natural resources is up somewhat over 20% for the year. And so if you had the traditional 60-40 portfolio, you would not have had any of those asset classes. And so people in that traditional portfolio, they're really going through the ringer right now. They have no place to hide except for cash.
Our portfolios are down maybe around half, depending upon how risky you are.
That's right.
A traditional or even a full investment in the S&P.
Yes.
Yeah. This slide is also really interesting because it shows over the course of time what's occurred. And so we can see 1 year we did have in the beginning of the past year, we're looking back now to June of 2021.
It's a trailing year. Yep.
Right. So you can see how we've done really over this past year, then over these past 5 years, and over the past 10 years. And again, this talks to the idea that really investing is a long-term game. If you're planning on being in the market for 1 year, so many people will come to me and say, oh, I just sold a house. I'm going to put my money in the market and we're going to buy a house, over the course of the next 9 months. No, that's not what you do. You put it in cash, you put it in the bank.
Yes. What is interesting here, by the way, is look at the return on the U.S. bond market over the last 10 years. Boy, that sure is poor, 1.5%. And that, of course, impacts that 60-40 portfolio as well. Yep.
Now, this slide shows us the past since March, I guess. So we're talking about the past quarter, so Q2, and the various headlines that have come out over the past quarter, and how the market fluctuates and gyrates every time a new headline comes out. And some of you may have watched our other video where we talked about, we actually showed magazine covers and commentary on the overall market or the economy, and then how the economy reacted afterwards. Normally what happens when we get bad information, bad news, bad thoughts, is that people react negatively. But then when people realize that was just a news item, that's not the reality of going forward, they'll correct themselves, and the market tends to move in the direction of finding the right equilibrium.
So I think the market, they say it anticipates bad news. It doesn't always. I think it may anticipate some broad strokes regarding what might happen, but it doesn't always anticipate bad news. And that's why you'll see, for example, the market go down for 5 days in a row because earnings reports came out that were terrible, and it was a surprise. They were expecting something a little better. So it doesn't always anticipate bad news, but in the long run, you can't trade on this stuff. You really can't.
Oftentimes it also is exaggerated too, right?
Yeah, it is. It's exaggerated. And that part of that's because people that shouldn't be in the market, that are in it and may need that money short term, well, they suddenly realize, well, gee, I'm losing money here, and they pull out. And what does that do? It lowers the price on stocks, because now suddenly you have more people offering stocks for sale. And whenever there's oversupply of a product, the price drops. Same with stock.
So it pulls everything down, everything, the good and the bad, it pulls down. And oftentimes what we need to do is we need to separate and understand where are the stocks that are actually priced appropriately and where are they not priced appropriately. And that's where we focus our time, is investing you in those organizations, those companies, those municipalities that are quality, their value. We can justify the valuation as opposed to speculative types of investments.
Well, we just added one ETF of late. I won't mention the name of it, but the price to earnings ratio of their holdings is around 7 or 8, which is really fantastic. Now, it was down a fair amount in the last month, but when a recovery starts, something like that is going to probably lead to recovery, because you're really not paying a lot to get $1 of earnings in a fund like that. And that really buys into our value strategy in general anyway.
This is another headline news type of chart where it shows you over a longer period of time since over the past year, and the various headlines that we actually saw there, and how the gyrations of the market moved things. And we could certainly read off anything from the oil to Biden nominating Jerome Powell for a second term. Every time something happens, people react in the market, and sometimes it's appropriate and sometimes it's not.
Sometimes when you look at a longer term graph of the markets, these things look huge in the short term, but they end up being small blips. if you're in for the long haul.
I think that might be obvious. That point, Steve, might be obvious on the next slide.
Yeah, I think so. Or no, one of the next
Or
slide.
in the future, a
Yeah,
couple of slides ahead. Yeah, this actually just shows US, well, okay, so when we look at US stocks, when we look at the entire world capitalization of all the different organizations, all the different companies on the public exchanges, the US stock market makes up 60%. Now, one of the things that when we hear that, we know that means that probably it makes sense that you have some international exposure in your investment. If you know that 40% of the overall capitalization is outside of the US, you
right.
absolutely should have some international exposure.
Yep.
On the right-hand side of this chart, what's interesting is it shows the different types of classifications within the US domestic market. And we always talk about small, mid, and large, and they really do operate differently. And it's important for people to have a real specific exposure to also that small and mid cap, but
That's
also
right.
the idea of value. And you can see how well large value has done, which is, it's, when I say well, it's all relative, right? The negative 12% in large value versus the negative 16% in large cap, which I believe is a mixture, is a blend, versus the negative 20.9%, which is large growth.
Yes.
So those folks that are focused on the S&P 500, that's large companies.
Yeah, I think the price to earnings ratio for the average large growth company was over 40, I believe, which is significantly high.
Still, Steve?
I don't know if it is that high now. I'd have to go back and check, but that's roughly where it was. We saw some companies that had price to earnings ratio of 100, but value was around 15 last I looked. It's probably around 14 now, I'm guessing. So historically it's been more around 13, so it may still be slightly overvalued, but it's not as highly overvalued as growth, and that's why we see these larger drops in growth in the growth sectors of these markets, small and large. And I want to mention, by the way, that when we look at that, there's two components to that valuation: is the price, but there's also the earnings. If we do experience a recession, earnings drop, you're going to see that the price to earnings ratios are actually increasing again, and they may still be a little out of whack. But typically when you hit a recession, companies' earnings tend to recover relatively quickly when you come out of the recession, especially for small companies, small value stocks in particular. They recover quickly coming out of a recession. And they typically lead the way, by the way, out of a recession. And you can see some pretty big increases, 20, 30% return in the first year out of a recession for small value, for example.
The next slide actually talks about the developed markets, which are those countries that are a little bit more
Europe, for example, European countries.
Europe, Japan.
Yeah, that's right.
Yeah.
South Korea. Yep.
And those are
Taiwan.
those are the international. So we said 60% was US stocks, almost 30% is the developed countries. And then the last sliver, maybe I think it's like 12% is emerging markets, which is the area that we stay away from. But what we actually focus on the developed in terms of making sure that you have both large cap and small cap exposure. And you can see here again, when we look at value, which is where we're focused, it's much better than in the growth component. Yep. But small cap international is continuing to have a hard time.
Yep. And we do lean towards small cap value internationally, but even it's been hit too this year. Probably not as much as small cap growth internationally, but still getting hit.
Emerging markets isn't actually being hit as bad as the developed countries, but we think that the risk associated with emerging markets is not worth it's not worth this benefit of
just want to go back real quick. And so we don't think so. And if you look at here, I think this is a good example. If you look at international small cap, the average 10-year return has been 6.7% a year. And that's with less volatility than emerging markets, which is the average return has been 4.3%. And that's with a lot more volatility. It's a lot more volatile.
And uncertainty, because there's political risk and other things
right.
that are additional risk compounded upon just volatility that make it worse.
And those are hard to quantify. You know, they don't really necessarily incorporate event risk a lot of times, or the potential for event risk is not always codified in the mathematics of when we look, or when people use to analyze investments.
Here we see the country returns across the board for the second quarter. And again, you know, China is really the only country that's up this past quarter.
And that's what I mentioned, that one country's highlighted. I go, that's global. That's the average for all of the countries there. The one that's kind of highlighted, just to make that clear. And the US is kind of right in the middle of the pack here, right? I think.
Yes. It's a little bit. So there's global, what is it?
Canada, less than global.
Australia and US.
Yeah.
That's,
and, you know, and I don't trust China, quite honestly, that number, because I've heard things that they're really having major problems economically. So.
Right. Well, that's the problem. If you can't even trust what they're reporting.
No, I'm not sure that I do. Yeah.
Right. So real estate is a really, really interesting asset class that has done quite well over the course of 20 years, for example. It's been one of the top performing asset classes. And when we talk about real estate and real estate investment trusts, specifically REITs, we're also always talking about the public traded REITs. We do not believe that people should be invested in private REITs. Private REITs have a whole host of problems. We really try to steer people away from them. We've had to, unfortunately, help people that have come to our firm to ask for help to get out of them.
Try to unwind
money was locked. Yes. So, but the publicly traded REITs can be very, very interesting and very, very diverse. And there can be some real opportunity. Unfortunately, currently, the REITs are not doing that well. They didn't do well in the first quarter or the second quarter.
No.
In both US and global. And so this is an area to watch, although we do think that at some point it's going to start turning up, if for no other reason, because of rents and the fact that these REITs own properties that collect rents and they're able to command higher rents.
And so we've had conversations with one of the mutual fund families that we use, and they've told us that the rents have been going up a lot. So their holdings are seeing a big increase in cash flow. And at some point, the market's going to recognize that increase in cash flow there. And it'll certainly be reflected in the recovery when REITs do recover. And they will. They always have. We've held this asset class since 1995, actually, and it's averaged about 11% return over those 27 years or so. So it's a great asset class to be in long term, and it's not completely in sync with the stock market, which means it improves portfolio efficiency, which is something Laura and I talk about all the time. And this graph, commodities, doesn't really reflect completely the performance of our holding. Our holdings, for example, this shows average 5-year return of about 8%. Ours is probably closer to 11 or 12 over the last 5 years on average. But that's a little bit of an illusion. It's a little bit of a head fake, because the bulk of that came over the last year and a half, by the way. Commodities up for about 80%, at least our holding, over the last year and a half. And our particular holding has roughly 16 different commodities in it, not all of the commodities that are shown on this particular chart. This year, our commodities holdings up about 20%.
Well, so we have in our current commodity holding, we are holding some of the energy pieces here. Definitely WTI crude oil and Brent crude oil. We also have the non-precious metals like nickel and aluminum, which
industrial metals.
Well.
Yep.
And a couple of things, the items in between, gold, and you can see gold isn't as great of a performer as a lot of people think that it
Nope.
is. We always try to encourage people to make sure, even in this particular asset class, to be very diversified into a lot of the different kinds of commodities, as opposed to just picking gold or just picking oil or just picking
Yep.
wheat, to make sure that you're holding all of that.
You know, gold is not always a sure thing in terms of something that you can use to hedge against inflation. I think you really want to have a broad basket of commodities in the investment, but also have commodities that actually have industrial uses. Gold has some industrial use, you know, contacts and computers and stuff like that, but it's not like oil. Oil is an input in every part of a production process, including, you know, energy in general, including bringing the product to market, you know, creating the product, the whole 9 yards. Oil energy is embedded in the cost of everything. So it's really energy to no small extent that really kind of leads the way for inflation, because it's embedded in everything else. And I think we've seen that energy prices are up about 60%, I think, over the last year. And that's been a big component of what's been driving inflation. Not entirely, but a big component. Also, food costs have been a driver as well.
Oil's down a little bit this past month, and so
it is. I think it's
so
around 100 a barrel now.
Right.
Which, look, you know, we all use it. You know, even though we have you in oil as part of your portfolio, in the long run, we'd rather not see it go up like that, because it really affects us. You know, the price of gasoline now, by the way, I think it's dropped below 4 here in New Jersey. It's actually gone down a fair amount in the last month, believe it or not. But I think the thought behind that is that people are driving less, believe it or not. So the supply is increasing. But that's how the market works. You know, something becomes expensive, people use less of it, and the price does drop because of that. That's how a free market should work.
Supply and demand.
Yep, that's correct. So.
And as we said, fixed income as well has not necessarily performed, but the yields are going up.
They are.
And we see that we, you know, again, we tend to stay away from corporate bonds because those are so highly correlated to the stocks as well. We tend to go more for the municipals or even treasuries, which are the we do get a lower rate on those, but we get that negative correlation to the US stocks, which is really important.
That's correct. And so what's happened too, because interest rates have gone up so much, the net asset value, or the price in a lot of mutual funds and ETFs that invest in bonds, have declined a lot this year. I've seen and I'm talking about major well-known bond funds from, you know, good investment houses, you know, 6 to 9% I've seen. And the problem with that is that though they never really mature, unlike the bonds we hold, the yield in those funds is, you know, maybe argument's sake 2.5%. It could take you 3 to 4 years before you recover that decline in the share price of the fund through the income that's being thrown off. So you may not be break even for 3 or 4 years on that. Whereas our bonds, we do hold to maturity, and on paper they may show a price decline. We're not going to capture that decline in most cases because we'll hold to maturity. And in the meantime, you are getting the coupon payments as well. So.
And this compares US, which you see is fairly flat, the yield curve. You can get an interest rate that off of a 2-year or 3-year bond that's almost just as high as one that's 20 years or 30 years. And that's a bit odd. And we see that in our market, we see that in Canada, and we even see that in the UK. We see a little bit of more of a incline in the yield curve in places like Japan, which I'm not sure what's driving that exactly, but.
And that's called yield inversion. And by the way, 2 or 3 days ago, the 2-year treasury provided more yield than a 10-year. Again, and we've seen that inversion occur a few times over the last few months. And I heard it was very high 2 or 3 days ago. And usually that was a sign that we're headed toward a recession, though I don't know if it's always been entirely accurate, and I don't think it has, but a lot of people claim that, it's sort of implying we're headed toward a recession.
And so while we could be heading for a recession, we could be even in a recession.
Yeah.
We want to make sure that we continue to remain focused on what we're trying to accomplish with our long-term goals. And one of the things that this slide shows you is it shows you recessions all the way back 100 years and how the market has reacted. And if you notice, when the market starts turning up, oftentimes it's actually turning up while inside of a recession.
That's
so
right.
Just because we might be in a recession doesn't mean that the market is necessarily going to go down.
Yep.
Which is an important
They've already priced it in at this point.
Right.
And by the way, I've been around long enough that I think about 5 of these recessions I've been through with clients already. So.
This is actually the slide I was thinking about before, Steve, when you said something about when you look at it in the big picture, it doesn't look as drastic
Yes.
it did when you're in it, and you see the little blip there, for example, in 2001 and 2008. You see these blips, and
it feels like the end of the world.
Right.
It does, and that's how we are as humans. We're all like that.
Yeah, this is actually an interesting, on the left-hand side, this plot chart shows on the horizontal line is the US stock return in excess of bonds. So it's what they call the risk premium. On the y-axis, I'm sorry, that's on the y-axis. On the x-axis is the real GDP growth, gross domestic product growth, which is how we measure whether we're growing in production or we're declining in production. And so when real GDP growth is negative, we're talking about the left-hand side. And when the market is up, we're talking about the top. So that left-hand quadrant there actually shows us times where GDP was negative, but the stock market was delivering a positive return. And that's important to notice that there seems to be even more dots in that quadrant than in the lower quadrant when real GDP was down, and so is the market. And it's important for us to keep in mind. The right-hand side of this chart is, we've actually talked about this numerous times. It's just another example of when the market, if we just look in the middle, the 3 bars in the middle, if the return, the market went down by 20%, then what the average return over the following year has been over 20% return, 22%. Over the next 3 years, 41%. Over the next 5 years, 72%. And the whole idea of, okay, you're going to tell us when that's going to happen. We've been down this road too many times to tell you that nobody that we know, and we know quite a lot of people in this profession with PhDs and CFAs, and in this profession, we know a lot. And some of the top names, we know them. Nobody is going to be able to tell us when that starts turning up again.
No, and we also showed that in another video that the average recovery for the first 3 months coming out of a market decline has been between 20 and 25%. And that's for the first 3 months. And so if you miss those first 3 months and trying to time when those 3 months are going to begin, it's going to significantly impact the amount of the upside that you capture. And you already would have caught the downside if you sold out. So you're going to be whipsawed badly by that. And by the way, this right here is a perfect reason why you shouldn't be concerned that we're in a recession. By the time we even know we're in a recession, the market's already declined, and most likely, Laura showed that. And now, if we are in a recession, the recovery could actually start soon within the recession. too. So we've seen that already.
So we're friends with one particular research investment group that we talk to quite often. They have quite a lot of PhD economists. As a matter of fact, several
Yep.
PhD economists, the leadership won Nobel Prizes in some of their research, and they really know what they're doing. They applied the science behind investing and everything that they do. And we wanted to show this particular article. Actually, was there a page before that, Steve?
Oh, did I jump? No.
Yeah, I think you jumped even before that, right? Yes, this was the first page.
Yeah, we did show that. Yes.
Yeah. Okay. Oh, I'm sorry. So this was actually part of this article. I'm sorry. So
Yep.
this was part of this article. It was published in Market Watch, and they showed this. And then the second piece,
Mhm.
so they said recession is not time to sell. Then they were talking about the fact that you want to weather the storm. And then the third point that they mentioned in this article was the idea of just not making sure that you have a good plan, making
Mhm.
sure that you understand why you're invested the way you are. And so I actually highlighted a couple of parts of this article where they talked about, we believe the only good reason to sell is if in fact you have changed your risk tolerance or your
Right.
goals have changed. All of a sudden now you need cash, you didn't know that you needed it, something happened in your family, good time to sell. Not because you're concerned about the market. Steve and
Right.
I are invested in the same portfolio as you are. My personal money is in a Model 6. Steve's personal money is in a Model 8. My mother-in-law's personal money is in a Model 5. And so is my brother's, I think, too. I mean, we're all just, we
Same
have
exact holdings you
this.
have.
We've
Yep.
learned that we've been through this so many times already. And the best thing to do is to just sit through it and just weather the storm. So it talks about the fact that, you know, we want to make sure that we're in the right place when the market does rebound.
Yep.
That's another highlight here. The diversification is really the top risk mitigation tool, and that is our focus. In the article, it asks about how many stocks do you own? Well, if you can actually name what stocks you own and the number of stocks you own, there's a problem there, because that means that you're not diversified enough and that you really should be exposed to much more breadth in the market. And then they mentioned in the article that if you're working with a financial advisor that knows what they're doing and has helped you plan out your overall plan, that to stay with the strategy, and that's really the most sound approach.
And I just want to mention one thing. We can actually take a X-ray of our models. I've done that. And I think our largest holding in anyone's stock is about 0.6%. So that shows you the breadth of diversification we have. Whereas in the S&P, at least at one point, 10 stocks represented probably almost 30% of it, I think.
Yeah, we've been actually doing that for some people that have come new to us with portfolios as well,
Yeah.
and showing them the X-ray report of, okay, you're holding all these different funds and you think you're so well diversified, but now when we look at what all the funds are holding, you can see that 70% of your portfolio is holding, you know, a couple of stocks, really.
Yes.
And that's quite interesting. So while we sit here and we're very much aware of what's going on, Steve and I are reading constantly. We're talking to professionals in the industry, people that are really smart and know what's going on. We are paying attention to the daily, the monthly, the quarterly information. And we want you to know that we don't see anything that's going on here. We see pain for sure. None of us is fun. We're not finding any of this fun. And
No.
but we know that we've protected all of us as best as we can. And we don't see anything here that's telling us the sky is completely falling. And so we just want to keep reminding you that we know what's going on.
Yep.
And we're not going to be making knee-jerk reactions. And just because this is what's happened in Q1 and Q2, we really don't know what's going to happen over the course of the rest of the year. And for all we know, we could wind up with a positive return over 2022.
We could, we don't know.
We'll have a party if that happens.
Yeah.
Okay. So again, as always, please call us if you have any questions. You might have seen a lot of writing on these slides that we were actually wondering whether we were going to publish this, whether we were going to just talk about it. If you want a copy of the slides, please let us know. We'd be happy to share it with you. So thank you again and take care, and we'll talk to you soon.